Well, it's 12 o'clock and I'm all alone in the Zoom room, but that's okay. Let me share some information with you so I can record it and put it up on YouTube so you can look at this at your own convenience. First of all, the Zoom meeting is at the address I sent everybody an email, not this one. So if you're trying to click on this one, it's not going to work. And here's where we're at. We skipped chapter 11, so the final exam is going to be on 12 and 13. We talked about chapter 12 last week, and we're going to talk about chapter 13 today and Thursday. And I can tell you already for Thursday, the problems at the end of the chapter that you are responsible for are 1 through 5. We're going to truncate that chapter right there. And I think that'll be enough for this week. It's been an unusual semester, and I appreciate all the work that you've done. And I hope that you learned something. So let's go take a look at the course and the lecture notes that I have uploaded to Educat, which you can download. And how come it's not downloading? There it is. There it goes. First of all, got to get that out of there. I was uncomfortable with the problem, as you know, the last problem from chapter 12. So this morning I did a little digging around and I found this link, which you can go and look at your convenience. But let's open the hyperlink. And this does a very, very good job of explaining bond pricing. So chapter 12 is pretty much summed up right here in this website. And most of this we know: semi-annual coupons, simplified bond pricing, annual coupon, semi-annual coupon. But here's the good stuff. Accrued interest, which is number 10. Listed bond prices are clean prices, also known as flat prices, which do not include accrued interest. And so if we're buying between coupon dates, as the problem does in the book, it's called a dirty price, the gross price. And then it includes the clean price plus the accrued interest. And so we have a nice example here of how to count the days, and more importantly, how to purchase a bond with accrued interest. So this is fairly straightforward. The accrued interest is calculated right here. So we're going to add that to the clean price. And this is the dirty price. And I think if you walk through this and study this and go back and look at the problem, it'll make a little more sense. Hang on 1 second while I send everybody the password again. Well. Okay. This also has some Excel functions, which we have not looked at, which you are welcome to explore. Zero coupon bond we're familiar with. And some other stuff. But I thought this was particularly useful for problem 10 in chapter 12. So that being said, let's go back to this spreadsheet, which I uploaded today, chapter 13, because this will all right, let's try this again. Everybody can't get in. Try it again. Well. I'll go back to here. See if that works. Well, we'll see if anybody joins at any extent. Can't do much more than send out the invitation again. And this is what I sent to everybody. There's one.
Anything?
No, thanks. Hello, Gabby.
Hi, Doc. The password is actually Fin351, not Fin462.
Stupid Zoom.
Yeah.
Oh, yeah. Huh. Well, you know why?
Why?
I just invited everybody to, no, it's 12:01:30. It's okay. Yeah. It's supposed to be finance FIN 462.
Mm-hmm.
All right. Let me send everybody an email and let them know.
No worries. I think Educat was also being a little bit slow. I think something was happening.
Ridiculous.
Yeah.
Well, it probably doesn't help that everybody in Northern is trying to use Zoom today.
Yeah, exactly.
Let me hang on one second. You're the first one in. Well, so far I'm recording this, so I'll put it on YouTube later anyway. But the first thing I was talking about before anybody showed up was I found this website, and the link's right here. This is on Educat, and it does a really nice explanation of pricing accrued interest for a bond, which was problem 10 last week. So I encourage everybody to take a look at that. And as I read chapter 13, or attempted to read chapter 13, hello, Alyssa. Welcome aboard. Send Troy the right password. Where'd Troy go? So I set this meeting up with a password of FIN 462, and then I turned around and set up another meeting tonight at 6 o'clock for my 351 Zoom meeting with a password of Finance 351. And so evidently Zoom decided that that was a password for both of them. So I apologize for the confusion, but it is what it is. Let's there we go. So on Educat, I uploaded this spreadsheet this morning, which kind of condenses chapter 13 into a nice little scavenger hunt, which is much more interesting than trying to read the chapter. I made 2 or 3 attempts to read the chapter, and that was just not a good chapter to finish the last week of this semester with. But I was mentioning, for those of you who are joining, that the first thing I did was I put a link up here for bond pricing as a really good example on accrued interest, which was problem number 10, chapter 12 last week. So take a look at that. I think it'll help you out. And then on 13, a couple things that you're going to have to be able to calculate. One of them is implied interest rates. And basically, this is a time value of money problem. So if you remember from back in 351, if we wanted to calculate the future value 2 years out, we could do it the old-fashioned way and take the present value times 1 plus the interest rate for the first year times 1 plus the interest rate for the second year, and that would give us the future value 2 years from now. And that's this is what we call in the old days, it would have been what we called FVIF, future value interest factor. So in this case, what we're doing is, in case of interest rates, we're looking at a problem where we can buy a 2-year 0 coupon bond or a 1-year 0 coupon bond and cash that one in and buy another 1-year coupon bond after the first one matures. And the coupon for the 1-year bond is 5%. The coupon for the 2-year bond is 5.5%. And we don't know what the coupon bond interest rate for the 2-year, the second 1-year bond will be. And what we learn is, Billy can't get in. This is fun. So what we have here is, because of what's called interest rate arbitrage, which we're not going deeply getting into this semester. What it means is that if interest rates are out of sync, in other words, if you got a 2-year bond, 2 1-year bonds have to provide the same return. Because if they don't, if the 2-year bond or the 2 1-year bonds return a higher interest rate, then you could buy one and sell the other, and that would allow you to capture a risk-free profit, which is also what we call it's what we call arbitrage, actually risk-free arbitrage. So what that means is that whether it's a 1-year, 2-year, 3-year, 5-year, 10-year, 20-year, all these interest rates have to be linked together in such a way that investors and computer hackers can't figure out a way to arbitrage interest rate irregularities to make risk-free profits. And the truth of the matter is that there are occasions where that can happen as interest rates move. But as as traders identify this and try to make this profit, they force the interest rates to correct themselves. So that's actually kind of cool. But at its simplest element, we're just looking at a 2-year situation. So we know what 1 year is, and we know what the 2-year rate is, but we don't know what the second 1-year rate is. So we know that 1.055 squared, the future value interest factor, has to be 1.113025. So that means that the first year times the second year that we don't know has to also equal that. So if we divide this by 1.005, we get 1.06, which leaves us 1 plus the second interest rate. Subtract 1 from both sides, and we find out that the interest rate in the second year, the second 1-year bond, has to be 0.060024, or 6%. And this is what's called the break-even yield, or the implied forward rate. And it has to equal this, otherwise you have arbitrage opportunities where people all over the world can jump in there and trade these interest rates and make money off of it. So that's basically all we're going to do with it. We could put a 3rd year in here. You know, you could have the 3-year rate here, and you could have 1, 2, and 3, or you could have 1, don't know the second rate, know the 3rd rate, and solve for the missing 1. It's basically algebra. But I don't think we're going to get that far. And here are a couple of websites that you can go and look at that will, you have to click on this. This cell here is where it's actually located. We'll open the hyperlink. I'll put it down here where you can see it. You don't have to watch the whole thing, but it's good.
In the previous 2 readings inside of this study session, the learning outcome statement words typically...
That's already too much. All right, but it's good stuff. And this one, Investopedia, always good stuff. Look at this one. How to convert a spot rate to a forward rate. This is exactly what we're talking about. So there it is. This is actually the condensed formula of what we just did. If you go back and look at the problem we just did, go back and look at the book, they have this formula in this section. So calculate the forward rate. Understanding it, good stuff to read. There you go, if you want to retire. Okay, that'll take care of that one. The second thing you're going to have to learn to calculate, which is good for you to know and from finance, is bond duration. And it's a little tricky. The book makes it a little bit hard to understand. The way to think about it, duration is kind of a weighted average payment of the bonds. So basically, the most important thing is that duration tells the investor how long it will take to capture their original investment. Now, you know that with bonds, as interest rates go up, the price of bonds fall. If interest rates go down, the price of bonds rise. That's the risk you have with bonds. So bonds have what's called interest rate risk. And the longer the bond is, the higher the coupon, or the lower the coupon, the more risk involved. So duration tells the investor how long it'll take to capture the original investment. So the issue I've got down here is the 10 payments of the 5-year bond semi-annual, and the MACD comes out to 7. That doesn't actually make 7 payments. So it's going to take 7.5 payments for the investor to get their money back. The thing to remember about duration is with the 0 coupon bond, the duration is always the length of the bond because there's no payments. Again, a couple of websites that you can go. And the reason I put these websites in the spreadsheet is I would strongly encourage you to go look at these websites and go through it. It's easy to understand. It's easy to calculate. It shows you how to do it. MACD, cash flow. This is actually almost the same as the book. I'm going to show you in a second. And it shows you the calculation. And then the other one is BlackRock's, which is a huge hedge fund, which I thought it'd be interesting to go and look at. Excuse me. Duration tells you not only how long it takes to get your money back, but it also gives you a measure of how the bond price will change if interest rates move. That's a very important conflict. So let's see what it says here. If there's 0 years, there's no duration. If it's 2 years and bond prices, if rates spike 1% and duration is 2 years, then the price of the bond will fall 2%. If inflation, if rates go up 1%, the duration is 4 years, the bond will fall 4%. 6 years, 6%. So this is pretty good to know. So take a look at this, and then after you go through these websites, I think if you go back and take a look at the book, it'll make a lot more sense. So the actual formula for duration is you can look at it in the book, but it's also right here. So what we're going to do is we're going to take each cash flow, each coupon payment, we're going to treat it like a series of payments. So you take cash flow 1 times its number, which would be 1, and then you're going to find the present value of that for 1 period. So if we're using the mathematical formula, it'd be cash flow T times 1 divided by 1 plus the yield to maturity raised to the first power. Then we go get the second payment. It's going to be second coupon times number 2. And we're going to divide that plus 1 plus the yield to maturity raised to the second power. Then we repeat this for all the cash flows. So you can see what I did here. Here is the first payment times, because this is a 5% bond semi-annual, so coupon payment is $25 times 1. It's a 4% yield to maturity, or 2% per coupon payment. A 1 plus 0.02 raised the first power. And then 25 times 2. Doing that right? Yeah. Divided by 1.02 raised the second power. And we repeat this for all of them till we get down to the end. And then the last one is going to be $1,025, because that's the maturity value in the last coupon payment times number 10, because that's the 10th payment, divided by 1.02 raised to the 10th power. And then you divide the whole thing by the price of the bond, which is right here. So the MACD for this came out to be 7.04. And since we're doing this on semi-annual payments, this is semi-annual periods. So it's 7.46 months. So it's basically what? Three and a half, a little over 3.5 years out of the 5 to get your money back. And that's duration. There may be, let's see. I didn't even look, see if there was a duration formula. There may be. Settlement, maturity, coupon, yield, frequency, and basis. All right, to do that, I'd have to look at the help screen on this to find out what these different things mean. I have an idea on most of them, but basis, I'm not sure. Here's modified duration. Okay, so there are formulas for it that you can explore. I just do it the old-fashioned way because that's the easiest way for me to understand it. Then the modified duration is simply the MACD, which is this one, divided by 1 plus the yield to maturity divided by 2. So there it is. That's right there. The MACD divided by 1 plus 2. Oh, divided by 2. Excuse me. There you go. Whoops. There you go. So this tells us how much the bond will change for a 1% shift in interest rates, if this is correct. If interest rates go up 1%, the bond price will fall 14%. That's what that means. So disregard, I have changed this to 14.52. You have to make these changes if you're downloading it. And then we have a term called bond convexity. We're not going to calculate it. If you've looked at the chapter and looked at the formula for it, you can understand why. I'll let you wait till you get to graduate school to worry about that. And who knows, there may be a formula for that too. Let's see. Nope. Okay. So we're not calculating it. However, you do need to have an idea what it means. So again, here's a couple of websites you can look at. Convexity. It's the measure of the curvature of the degree of the curve of the bond, which shows how sensitive it is to interest rate changes. So you can see this bond, the convexity is much more than this bond. This one is actually a flat line. So that's basically all it is, and it's used to measure interest rate risk. So The higher the number of the convexity, the more risk involved if interest rates change. So here's the important things to remember. You can take a look at those and then go back and skim through the chapter. I think that'll help that way. So what we got here. Tried to use some different websites. So this is Wikipedia. I don't use it a lot, but same stuff. There's your formula if you want to. I didn't use this because it does derivatives using calculus, and you are not required to have calculus in the College of Business, although some of you probably had it in high school. So you're welcome to look at that if you'd like. And the last one is Raymond James. One of these is explanation, duration, convexity, positive and negative convexity, and a conclusion. So these are all to help you out. I think, again, that's why they're there. And then we have some stuff, bond with embedded options. This is a little thicker, a little more hard, maybe a little bit difficult to understand. Let's take a look at this. Here we go. What is an embedded option? Well, if you remember, an option, basically a financial option, gives you the right but not the obligation to either purchase or sell a financial security. So that must tell us that this embedded option must have be embedded in the bond. So a bond with a put option would give you the right to sell it. If it falls below a certain price, you still can sell it for a higher price. Or a call option would give you the right to buy it at a specific price. So options are used as sweeteners in bonds, which means that it allows a little bit lower risk, makes it a little more exclusive to the investor, and allows them to get by with a lower interest rate or lower coupon payment. So we're not going to get into evaluating them, but here is the explanation. The types: prop provision, cap floating rate, put provision, convertible. These are all what we call sweeteners. So they're used to make the bond more attractive to the investor, which makes a bond issue that otherwise might not be able to be sold. The investor will take it, and it also allows okay, that won't work. All right. I guess you have to search for that one. But basically, it allows the company to offer a lower interest rate, a lower coupon payment, and make it more attractive to investors. And then we have a section on yield spread analysis, which you need to look at, and that sounds kind of hard to read until you start looking at the explanations on like Investopedia. It's the difference between the yields on different interests of varying maturities, credit ratings, risk levels, and so forth. And it's basically expressed in basis points. And for most of us, the first thing we have to learn, hey Nick, how you doing, is what is a basis point?
Good.
And what you want to remember is that 100 basis points is equal to 1%. So if we're talking about 1% difference here, that is 100 basis points. So if it's trading at 50 basis points, it's a 0.5% different. And that's basically looking at credit spread. Here's the key takeaways. The yield spread between a quoted rate of return, they have different maturities, ratings, and risk. It's actually straightforward. You just calculate the yield from one to the other in terms of percentage or basis points. And it's usually used in terms of US Treasuries versus corporate bonds. And I think one of these talks about how to trade them. So let's look at the next one. CME Group. This will be a pretty professional explanation. Here's the yield curve spreads, flattener and steeper, for those of you who want to investigate how they do this. Chicago Mercantile Exchange. A lot of interesting stuff going on there. I threw that up there just to expose you to them. And then here's 3 keys in spread analysis. When spreads are forecast to widen, that decreases returns. When they're projected to narrow, that will enhance returns. When the spreads narrow, longer duration bonds will gain more value than shorter duration bonds. When spreads widen, longer duration bonds will lose more value than shorter duration bonds. And one of the things you can do is you remember the dynamic yield curve that I think I showed you on stockcharts.com. It shows the yield curve from the 30-day Treasury bond out to the 30-year Treasury bond. So you can actually look at that very quickly and see how these spreads are moving over time. And then we have mean reversion. You buy bonds if the current spread is greater than we are predicting the spreads will narrow. And you sell the bonds if the current spread is less than the prediction that spreads will widen. So interesting stuff to read. Okay, that's all there is. So that's one you can look at. And then we have the option adjusted spread. And for those of you that don't want to go look at the website, I just put the formula on here for you, so you can just go ahead and work through it. I'm being cute. I couldn't work through that if I had to. It'd take me a long time to figure that out. So what's an option adjusted spread? OAS, not the group Oasis. Option adjusted spread is a measure of the spread of a fixed income security and a risk-free rate, which is then adjusted to take into account an embedded option. Well, that sounds pretty intense. I think if we study the takeaways, the difference in yield between a bond with an embedded option and the yield on treasuries. And embedded options are provisions included with some fixed income securities that allow the investor to do specific actions such as calling back the issue. Using historical data and volatility modeling, OAS considers how a bond embedded option can change future cash flows and thus the overall value of the bond. So this is another sweetener that's given attached to the bond to make it more attractive to investors.
You're not safe. That's never going to be more clear than it is right now. I don't care if you live in the suburbs or the city. You can.
Okay. We can look at a minute and 20 seconds.
The option-adjusted spread, or OAS, measures a fixed income security rate spread and the risk-free rate of return that's adjusted to account for an embedded option. It considers how an embedded option can change a bond's future cash flows and overall value to differentiate between similar products that have embedded options. Analysts typically use treasury securities to represent the risk-free rate. The spread is added to the fixed income security price to make the risk-free bond price the same as the bond. The OAS looks at changing interest rates and prepayment risk and is frequently used to value mortgage-backed securities because of their prepayment risks. Mortgage-backed securities, or MBSs, are bonds representing an investment in a pool of real estate loans. They often have embedded options due to prepayment risk, which increases as interest rates fall. A larger OAS means the risk is greater, so the return should be greater too. The OAS method is used because it's more accurate than simply comparing a bond's yield to maturity to a benchmark.
There you go. So again, review this, and then use that in conjunction of the book. And then I thought I'd throw this on here, Robinhood. Another explanation. We use OAS to better compare bonds with embedded options to traditional bonds. So mortgage-backed securities are subject to call because as interest rates fall, the people that have mortgages that are included in these packages refinance. There's a lot of refinancing going on these days. All right. There you go. An option adjusted spread is like converting apples into oranges into apples. I'm sure that'll be a test question on the final. I'm just kidding. And when we have some bond portfolios management strategies, again, same concept. Take a look at these and then go back and look at the book. And here are the 4 strategies: buy and hold, index matching, immunization, and dedicated or active. And you can read through the explanations. Bond laddering is mentioned in the book, so that's a good thing to study and know. Indexing, immunization. You should understand that immunization for bonds is basically a way of putting together bonds of different maturities, different coupons, and so forth to build a bond portfolio that is immune to interest rate changes to a certain degree. So you can build a portfolio so that you can guarantee to your investors you're going to get this return no matter what happens to interest rate changes. The duration helps with that, but combining the different types of bonds, here we go, duration, commonly used, but the composition of the bond portfolio also affects that. We have Axum management, trying to get the highest return. And that's pretty good. And we have FinPipe, another website with some different strategies. Interest rate anticipation, yield curve strategies, sector rotation, security selection, and that's pretty straightforward. And then Fidelity. Why not give the big boys a chance too? This is interesting. Ladders, mentioned in the book, barbells, bullets, something different. Explains what they are. And then how to monitor your strategy. And then you're ready to go open your account. And then we have some stuff on global bond investing. Here's one, The College Investor. Why consider the global international bonds? Where does it fit in a portfolio? Well, one thing, it depends on the size of your portfolio. There's a little more risk involved sometimes, but the return can be greater. One of the best ways to do it in this country would just be to do it through an ETF. And for those of you that are like me, dummies investing in global bonds. Always like this stuff. And then on immunization, that's some Morningstar information. Morningstar is a really good website. Immunization. Minimize the interest rate risk of bond investments by adjusting the portfolio duration to match the investor's time horizon. So we want to put together a combination of bonds, lock in a fixed return, so the investor can hold the investment to meet their horizon, which means, do they want to cash out in 5 years, 10 years? That's the horizon. So that's what we do. Here's how it works. Considered a quasi-active risk mitigation strategy, since it has characteristics of both active and passive strategies. So this is the text on this stuff for me is easier to read in a book. And then when I read this and then go back and look at the book makes more sense. Key takeaways, real world examples. Good. I'll let you look at Zacks. And then we have finally horizon matching. NASDAQ, haven't looked at them today. See if it loads. Nope. All right. Well, CME Group. Oh, we looked at that one. Sorry. We're down here. So horizon matching. This is how complicated this is. It cash matches over the next few years and duration matches them. That's their whole explanation. Go back to Investopedia. Here's the key takeaways. 2 types of dedication strategies safeguard the funding of liabilities when they're due. Balance the opposing effects interest rates have on price return and reinvestment return on coupons. A multiple liability Immunization strategy pays off better when interest rate shifts are not too arbitrary. And cash flow matching relies on the availability of securities with specific principles, coupons, and to work. So this would be more complicated to put together. And then a little more about immunization. So I strongly recommend that you take the time to take a look at these websites if you can find them. And then, as I mentioned at the very beginning, for this chapter, you're going to be responsible for the first 5 problems at the end of the chapter. That's all. That'll be enough. No sense getting too crazy. It's been a wild semester. I was planning on being in class today, and then yesterday changed. So Thursday, we'll have another Zoom meeting. Hopefully, it'll be a little bit easier to operate since we all know the password is FIN 351, whether we like it or not. And we'll take a look at these 5 problems and see if anybody has any questions. Otherwise, you can plan on checking your email this weekend, Saturday, Sunday, and I will send out the password for the exam. It'll open Monday, and you can take it Monday or Tuesday. You don't have to wait until Tuesday at noon. You can take it at your convenience and wrap it up. And if you haven't done so, please do the course evaluation. I sent a link out for that yesterday. And otherwise, I'll see you Thursday, or you can watch the video. I'll post them on YouTube in a little bit. And I appreciate you bearing with us this semester, and I hope that it was a worthwhile experience for you. All right? Any questions?
All right. See you later.
Okay, thanks.